Yes, Mariana, I think that we can start now.
Okay, so welcome everyone. This is the second session on TCFD. Welcome Nicola, welcome Richard, and thank you very much for joining us and supporting these efforts that are led by the National Banking and Securities Commission. And following up with our previous session, which took place last Tuesday, the idea is to further delve into the pillars of TCFD. So without further any comments, I would ask you if you can please start. And for all the audience here, please feel free to write your questions in the Q&A button. And the panelists will answer them at the end of the session. Thank you very much.
Thanks very much, Mariana, and hello, good to see you all again. Good to be here again with you. We are continuing today on the second training session on the TCFD reporting framework. I'm Nicola Swan. I'm speaking to you from very early in the morning in New Zealand, and I'm very pleased to be joined by Richard Folland, who is speaking to you from in the evening in London. So we are really happy to be with you here for the second session. I am going to share my screen if Mariana could, or someone is able to enable the screen sharing, and then we can get underway. We thought what we'd do to begin this session is just quickly pick up from where we left our final session. Great, thanks for enabling that screen sharing. That's brilliant. So we should all be able to see these screens now. Today, we're going to be looking particularly at the governance and risk management disclosures of the TCFD and climate risk reporting. And I wanted to, particularly for anyone who's joining us for the first time since and was not able to be at the first session, we are speaking today around the 4 pillars of TCFD reporting for climate risk disclosures. And we are looking at the governance and risk management disclosures today. These are traditionally the more straightforward disclosures that entities make when they are doing climate risk work. And they are also the disclosures that are somewhat more straightforward for regulators to prepare when you are considering bringing in a new climate risk reporting regime. And so in our second session today, we will look at these 2 in some detail and use these as a good background for getting into the more complex disclosures under strategy and then the metrics and targets categories of TCFD, which we will look at in detail in our third session next week. So, as you'll remember from the first session, there are 11 disclosure recommendations that the TCFD recommends, the International Task Force on Climate-Related Financial Disclosure, which has been in place for 5 years or so now. And these 11 recommendations have really stood the test of time in that the most recent international guidance is still based around this basic structure, and it still focuses on the 11 disclosure recommendations that were first proposed by the TCFD in 2017. And so you can see there today under governance, these disclosures are what are described mainly as qualitative disclosures by entities, and they require the entity to describe the board's oversight or the governing body's oversight of climate-related risks and opportunities, and describe management's role in assessing and managing those risks and opportunities. And when this first came out, these disclosures were seen as being relatively straightforward, pretty easy to do quickly. You can explain in a couple of sentences how your board might oversee climate risks and opportunities. And that initial sense has now developed into a series of disclosures which are actually relatively advanced. And so in the rest of the presentation, I'm going to take you through a number of examples of these disclosures, particularly in the financial sector for this audience, so that you can see the types of disclosures that are expected, so that you can assist in thinking about how these disclosures will link to other parts of the regulatory framework in Mexico. And for those who are here attending as entities that may need to report, you get a sense of the types of disclosures that are expected. And then there's the risk management disclosures, which are also viewed as relatively more straightforward because they are disclosures for the main that are also qualitative and that describe processes. So processes for identifying and assessing climate risks, for managing climate risks, and then for working out how these risks are integrated into the business's overall risk management. And often entities, banks and the financial sector will have an enterprise risk management framework that these risks, that this process of risk management can be integrated into. And that's one of the most important things to reassure entities who are considering starting to report along the lines of the TCFD recommendations, is that it's really important to think about what the organization is already doing in terms of risk management and think about how climate risk management can be built into the existing system so that you're not reinventing processes from scratch. But also thinking about whether climate risks may be different in any way and making sure that that is appropriately catered for. Just a quick reminder on the latest international guidance in this area. The ISSB, the International Sustainability Standards Board, which was released it's set up in November last year as part of the international climate change negotiations, has been working in with IFRS, the International Financial Reporting Standards Authority, and has released an exposure draft for climate-related disclosures, which was only released on the 31st of March, so it's only a few weeks old. And this is the most useful guide for you in Mexico in terms of looking at where the international guidance has moved to. So there's been a number of developments in terms of the original TCFD guidance and some useful further guidance released last year by the TCFD itself, which we covered last session. And then this guide published by the ISSB, which is currently out for comment, is the best way of sort of seeing exactly what the disclosures are likely to look like, and is a good guide for you to think of as being the backbone for your Mexican climate risk disclosure standard, which would be the main piece of work for the regulator that is charged with developing this regime. One of the first tasks is, as we covered last week, to look at which entities are covered and how the regime is going to work. But then the second really important task is to develop the content of what these climate-related disclosures will be, what the expectations of that content are for Mexico and for Mexican entities. And so you'll be drafting a standard which is largely based on this prototype. And so I'm drawing from some of the examples in that today so that you have the latest. One of the interesting changes, if I just flick back to the screen, is that in the latest international work, the third box includes how the organization is identifying and assessing climate-related opportunities as well as risks. And so you can see how that's moved in the development of this as it's progressed internationally. So to take our first section, which is governance, again, this is the board or governance body's oversight and then management's role in assessing and managing these risks. And for obvious reasons, they're drawing a distinction between the oversight and strategic role of the board and then the much more day-to-day hands-on role of management. I've just included here in the slides so that you have all of the details, the original disclosures from the guidance, from TCFD. But what I thought I would do is just skip straight to this slide, which distills the key points just with a little less detail so that it's easier to work through in the setting. So this is the key elements of the governance disclosures that are in the ISSB prototype example. So the first one is the description of the board role, and importantly, the prototype recognises that this need not be just a board, that it's a governance body. And in New Zealand, as we've been working through the development of this reporting system, the banking sector in particular has called out for the standard setter to refer to the role of the governance body rather than of the board, in particular to reflect the fact that banks can be operating as on the ground in Mexico, for example, as branches of an international global parent bank. And so the governance body is a better way of allowing entities to report on how this risk is managed, rather than specifically limiting it to the board of the particular local registered entity. And what we've seen in this area is that for those banks with global parents or fund managers, for example, with global parent companies, there will be those in the local body who are charged with the responsibility of this climate risk reporting at the local level, but they will draw heavily, and particularly in the governance disclosures, they will draw heavily on experience from the global parent. And so when they're reporting the governance of this risk management for, say, the Mexican local level requirements, they do need to explain how they are connecting these issues throughout the global business as well as just the local. So description of the governance body or the board's role in management of climate risk. And here we have how responsibilities are reflected in the board's terms of reference and mandate. So that expects that these responsibilities have been reflected and incorporated specifically in the board's reference and mandate, and that requires a change of policy, a change of documentation at the board level. How correct skills and competencies are available to oversee climate response strategies. So this is specifically suggesting that boards of, in this case, financial institutions, do need to be assessing whether or not they have the particular skills and competencies on the board to be able to deal with a climate response strategy in the business. So do you have someone on your board who can properly oversee the management of these risks and who can progress the potential opportunities that arise? This one is difficult for a number of entities who don't have anyone on the board with that particular expertise, and often it is taken up by the person on the board who's responsible for risk more broadly, or the risk and audit committee of the board. But it can be difficult because if you are being required to disclose how these skills are available and you don't have any specific skills in this area on your board, then it does put some pressure on bodies to think about whether or not they need to upskill existing board committees or the board as a whole, or whether, if they think it's sufficiently critical, that they actually try to introduce someone onto the board with these competencies. And I've seen that happen a few times. The process and frequency by which the board is informed about these issues. So again, there's a real expectation that the board is putting in place a formal process for reporting up to the board on these issues, and that's a regular report. And I'll show you some of the ways and how that's been achieved. The most substantive disclosure here is the next one, which is how the board considers risks and opportunities when overseeing strategy and major decisions. And there's a specific reference here in the ISSB prototype to how trade-offs are assessed. So this is where there's a delicate line in terms of businesses' annual disclosures, where you need to explain from a process perspective how the board does this. And then you may, in your annual disclosures, then also want to talk about how, how particular strategic decisions have been made. And here I wanted to use this as an example. So in this risk management section of TCFD reporting, the aim is that you describe the process for how you do this at a general level. If you were actually talking about how a specific decision had been taken, or how specifically your strategy had been changed. So for example, you moved away from lending to a particular sector, that would be a disclosure that you would make in the separate strategy disclosure section of your reporting, because in the strategy section you are reporting how you've identified and assessed risks and opportunities, and how your strategy has changed as a result. But this is, in this section, you're describing how you would do that. And the aim here is to show users of this information, and so key stakeholders, customers, investors, etc., whether you've got good processes in place to be able to do this. And then, of course, how the board is overseeing, in this case, specific climate targets, and how the board is monitoring progress, and whether this the management of climate risk is incorporated into remuneration, either for the board or for management. So here again, there's an expectation that the board is actually overseeing climate targets and is actually monitoring progress. Sometimes this is as simple as explaining that the board is reviewing these issues on an annual basis, but as this area becomes more advanced, there's certainly more of an expectation that the board is monitoring this more closely than just an annual report, and you can see that in the disclosures coming through. In terms of the second set here, which is management's role in assessing and managing risks and opportunities, again, these are process-based, and you can have a particular management role that is responsible for climate risk and climate opportunity across the business. Now that's tricky depending on the particular business, because of course managing climate opportunities is a lot about new product development and investment development, and investment, moving investments into areas that are aligned with a lower carbon economy, and that doesn't necessarily all make sense to have sitting within one person within the organization, or even and one committee can also be problematic. So actually how this is managed within the business is very specific to the business itself, and I've seen a range of approaches taken. How oversight is exercised over that role, so whether or not there is a direct reporting line to the chief executive, for example, is something that users are interested in. Is this something that is being taken really seriously within the entity or not? Any dedicated policies and procedures around how management is to do this, and often that relates to how different parts of the business work together, and how different committees or working groups or particular managers are supposed to work together within the organization. And then how, if there's a particular role that is covering this area, how that is integrated with other internal functions. So that all sounds rather dry. And before we jump just into the detailed examples, Rich, would you like to just offer any thoughts at this point before we jump into the detail?
Thanks, Nicola. Yeah, I just wanted to highlight a couple of points that Nicola has made here based on my experience working with institutional investors in Europe and the UK. And it's around expertise, both at the board level, but also as Nicola was describing, management level as well. And at the board level, I think we're seeing quite a sort of bit of questioning around, is there that sort of more dedicated expertise, knowledge around climate change with perhaps a particular director, could be a sort of non-executive director on the board, and just to sort of illustrate, if one's talking about, say, an oil and gas company, for example, and if the board, both chair and so on, but also the non-executive directors coming purely maybe from the oil and gas industry, perhaps the investor might ask questions there about, you know, how is there sort of that diversity of knowledge and experience. And at the executive level, perhaps an example of bad practice, but we do see it a little bit, is with companies who might combine climate change, environmental responsibilities with other areas like health and safety, for example. One sees often those sort of all traditionally lumped together, and investors looking, you know, a little bit more for that dedicated role at the executive level as well. So, Nicola, I hope that's helpful. Just wanted to add those insights from over here in Europe. Thanks.
Yeah, brilliant. Thanks, Rich. So what I've done now is, and you may recognize this one from the introductory session, is I have pulled together a number of examples of how this reporting is already being done, particularly in the banking sector. And I'm drawing on some of the really great examples we've got from the UK in this area, particularly from banks that have been doing this for a couple of years already. Some of them are into their sort of third TCFD report. There's not many who have more than around 3 reports now, but there's been a lot of progress in that time, and it gives you a sense of exactly what is being expected here. So from Lloyd's, you can see here they've got the board structure on the left. They're separating out climate risk from environmental sustainability strategy on the far left, and that's a good example of what Rich was just describing in terms of separating these issues out. They've then moved down into the more specific committees, and they have a climate risk executive forum at the bottom of the table there. I just had a hand go up. Please, if you're able to ask a question, please jump in. Oh, the hand has gone down again. So please jump in if someone did have their hand up. There's then a board risk committee chair statement, and I think this is something that is useful to see for users looking at these reports, to see the person behind some of these structure diagrams. It's a really useful way of making this more real. And so there we've got the chair of the board risk committee in that instance. And then what I thought was really useful, and I wanted to show this again, although I did mention it in passing in the first session, are the key discussions and decisions that the board has had in 2021. And this is one of the best examples I've seen of demonstrating serious governance of these issues, because a user can instantly see the types of discussions that have been had at the board level. And so you can see there that there have been, specific topics have been discussed around portfolio alignment activity required to achieve the group's net zero ambitions, progress in relating to, in this case, it was helping Britain recover in terms of a post-COVID outcome, but in terms of aligning this with some of the climate risk reporting, the particular scorecard performance measures that the bank is holding itself to, enhancements to the group governance structure. And then you can see at the bottom there, I thought was interesting, the skills and capabilities required to achieve our ambitions. And one of the things I've seen boards doing when they don't have a particular person who's responsible for these issues is they engage in deliberate board education activities. And so they focus on putting on sessions for the board to improve their understanding of climate science, of policy, of how financed emissions are working, so that the board's knowledge of these issues is growing as all of these issues are becoming more mature internationally. And you can see some of the key decisions there. So you've got the specific approval of the sector ambitions and approval to join the Net Zero Banking Alliance, for example. Some of the more specific ones was the risk mitigation strategy for the proposed transition to electric vehicles in the UK. That was a key decision that was taken at the board level. The next example I have here, another large UK bank, NatWest. These are, the way they've done this is they've set out the progress that they've made in 2021 and then compared that to future priorities. And you can see broken down on the left these two key parts of the governance disclosures, the board's oversight and then management's role. So you can see here that in 2021 they've taken sort of relatively straightforward progress here in terms of key areas of discussion around climate strategy, climate scenario analysis, embedding climate measures within remuneration and performance structures. So that's a direct response to the expectations that the TCFD guidance gives us. And then you can see here also the boards at NatWest Group's principal subsidiaries is exercising oversight of these risks and opportunities. Now, when I look at these disclosures, I can see that they're relatively introductory disclosures, and so they're demonstrating that the bank is getting across these issues, and this is the kind of statements you would be expected to see in the first couple of years of entities in Mexico, doing this reporting for the first time. And then as they become more advanced, you're going to get much more granular disclosures around what the board's doing. And I think that's the thing to take away from this session, is that, as we talked about last time, the international expectations on this are moving so quickly that building capability is just so important. It's so important to start encouraging entities to do these disclosures so that they have a chance to get up to grips with what the sort of scale of what they're being expected to do, so that then they can start to produce the more sophisticated disclosures as time goes on. One point down the bottom of this one, which is useful, is it references the Climate Change Executive Steering Group, which acts as the primary forum responsible for overseeing direction on commitments, climate-related commitments. And so the Executive Steering Group, this will be a group of the key managers across the bank that are responsible for these issues. And that structure is something I've seen a number of times, that businesses are establishing an executive steering group or a climate risk committee or a climate risk forum within the business, both at the executive level to allow the key executives to come together, but also sort of more broadly within the business, so that employees within the business can come and contribute to the development of these policies, for the particular business. So you can have different structures set up at different levels there, which I'll show some examples of. This is a particularly good example of this. So you can see here we've got the board structure at the top for this bank. You've got the board risk committee, the audit committee, as you'd expect, the sustainable banking committee, which is a relatively novel committee at the board level, and then the performance and remuneration committee. And they're explaining here exactly how each of these committees is relevant to climate risk and opportunity management. You then have in the green the various different executive level structures, and you've got there a number of committees: the Executive Risk Committee, Executive Disclosure Committee, the Climate Change Executive Steering Group, which is that steering group I mentioned earlier, and then the Reputational Risk Committee. You can see that here, for Reputational Risk Committee, the climate risk will be one piece of what they are looking at, while the Climate Change Executive Steering Group, on the other hand, is very much set up to, as it says, deliver and implement strategic climate ambitions. And this is one of the things which I've noticed from entities that are having to do this, that there's a difference between the larger banks and then the smaller or larger entities and then the smaller entities, that the larger entities have got a lot more choice in terms of the range of ways that they can deliver on strategic climate ambitions. But it doesn't mean that they can avoid disclosing how they are managing, that the smaller ones can't disclose how they are managing these issues, even if it's less sophisticated than the larger ones. Yes, there's just another hand up.
Hi, Nicola. This is Mariana. We have been receiving some questions in the Q&A, and I think it's important to maybe answer them right now, because he's referring to NatWest and Lloyd's examples. So I'm going to read them. So,
perfect. And just before you do, Mariana, could someone make me a host or a panelist so that I can see the questions? Because I don't think Rich and I can see the questions at the moment.
Yeah, that's right. I can't see them either.
Okay.
Thank you. But please, if you can take us through them, that would be great as well. That's happening.
So the question is, usually in Mexico, financial institutions have a risk committee. As seen in Lloyd's example, would you suggest having climate risk be included here, or be treated separately or transversely as NatWest does? What are the advantages and disadvantages of these two options?
Thanks.
That's a question. And another one that I think it's also sort of related. It says, when disclosing information on governance, what is your advice on how to answer? How much detail should be provided? Should evidence be added? What a good TCFD-based report looks like? Can you please delve into Lloyd's and NatWest reporting, since they look very different?
Yes, great. Thank you. Really good questions. And Rich will be smiling, because we get these questions often, and they're good questions to be asking. In terms of a separate risk committee or a specific risk committee, there's no clear answer. I think Rich's point before is a really important one. If there is a separate committee established at some level to deal with climate change risk and opportunity, it does signal that the bank is taking this very seriously and devoting resource to establishing a particular committee. So my sense at the moment is that actually it is useful to have a separate committee. That said, I think as this new reporting regime becomes more mature and reporting entities become more confident, they will be able to bring those committees into their existing risk committee, for example. And I think that's because the whole point of this reporting is to embed climate risk strategy throughout the business as being a sort of an essential piece of how the whole business is operating. But at the moment, because this is relatively new, it's perhaps more useful within the entity to have it in a specific place, but with the aim of then ideally disestablishing that separate committee, because these issues become embedded right throughout the business. How much detail to go into? Look, at the beginning, you tend to see the types of broader disclosures that I was showing before on the previous NatWest slide. I think as you get more advanced, you get more and more detail, and I'll show you some of these details so that you'll see in this session the options. I think the more detail, the better, but from a regulator's perspective, you can't expect too much detail in the early years. And some of the really good ways that entities I've seen have dealt with that issue, that they can't report in too much detail because they actually don't know internally yet what they're doing, is they'll publish a time plan where they will have the steps that they intend taking each year. So in the first year, we looked at one of these last time, in the first year they might say that they're reviewing and establishing specific governance structures to deal with climate risk and opportunity. And in the second year, they might benchmark that against others in their sector. And in the third year, they might have a review of it. So you start to get, a sensible degree of progress.
Nicola, that's great. Could I just add
Please.
one point? Because I wanted to underline what you were just saying about the importance of what you called embedding climate change, into the broader financial considerations of the business, and that is really important, because what that demonstrates is that climate change is being considered as a material issue, as financially material, either in a risk or in an opportunity sense. So, as Nicola was saying, in the internal structures there that say that if there is a climate change committee but has the authority to bring these issues to the main risk committee in, say, a financial institution, but also as far as the reporting is concerned as well, to demonstrate really that climate change is not being put in a silo, that it's embedded, it's mainstream as far as financial and business considerations are concerned. Thanks.
Yeah, thanks, Rich. That's brilliant. Okay, so just continuing through the slides, we've got a few more examples for everyone. Here's another good example from Barclays. So here you can see they've got the board and then the audit and risk committees. They haven't set up a separate committee, so this is a good comparison example. So here they have worked the management of climate change into the board risk committee. They've also got down at the management level a separate climate risk committee, and that feeds into the group risk committee. And then they've got a separate climate transaction review committee, which is particular for this as a bank, which I think is useful. And then they've got a sustainability steering committee. But I think another important thing here is distinguishing climate risk from sustainability more broadly. That can be useful where you are being required to particularly report on your climate risk and opportunities. And that's another one that, as businesses become more mature in this, it may be that climate risk becomes then wound into the broader sustainability picture. But I think at the moment there's such a focus on climate and the transition to lower carbon and net zero that drawing out climate can be useful as you are seeking to demonstrate to your stakeholders that you're focused on this. This was a good example. This one is again from NatWest of explaining how board members are being trained to increase competency to then enable a response to that particular disclosure. So this was how board risk committee members were given internally developed video training on scenarios, climate risk management, etc. And then there's a session here. This is an example of reporting of how the executive steering group on climate change, chaired by the group CEO and CRO, Chief Risk Officer, has been operating as the primary management forum, and what they've been doing, what their key focus is, etc., etc. Here's another one from Lloyd's, just in terms of the reporting. I've just pulled this snip again of the one that we discussed earlier in terms of the key decisions that were taken. But this is on the left, there was a sort of a more high level statement as to how the reporting is working. So the board's receiving updates on public policy and corporate responsibility matters. These included ESG matters, including climate change. And then they've said 4 climate-specific updates were provided to the board, covering areas such as progress on a climate strategy, policy updates, industry trends, engagement, and target setting. And then in addition to these board briefings, they're having then a number of separate engagements on a range of matters relating to the group's climate strategy. So that's a fairly straightforward but perfectly adequate disclosure of how the board is being informed on climate risk. But I think you can see it's much more effective to see the graphic on the right, which has the key decisions identified, than it is to have sort of a more bland statement of what is being reported to the board. So you can see how these disclosures can be used by businesses as an advocacy tool of what they're doing. Bank of England, here you've got up at the governance level, just for what they've done in 2021, established a bank-wide climate strategy, etc. Established an executive directors level climate steering group. The steering group option is quite a common one. And then you've got, this is Bank of England again. Here you've got the names of the individuals who are responsible for governance of the bank's work on climate change. And here again, you can see we've got, this is at the executive level, you've got an executive director's climate steering group feeding into a number of different commissions and committees, and then they've got a climate strategy built around their 5 goals, which is you know, just a useful sort of link there to what their strategy is. So I'm going to do the same thing with the risk management disclosures. We've got here, these are the sort of key things that are being required in these disclosures, the processes for how you identify, assess and manage these risks, and then how you integrate that into the business, into your existing risk management. And I'm just going to skip straight to the, here it is, this is the ISSB examples most recently. So what you need to disclose are the process by which risks are identified, so how this is done within the bank or entity generally, how the likelihood and impact of these risks is identified, including any quantitative thresholds that you're using. So what impact will these particular risks have on the bank? And in the strategy section of the disclosures, you get the requirements for the actual impact on financial cash flows, financial performance, etc. But this is driving at, how does the entity work out how likely specific risks are? Then how you are prioritizing these risks relative to others, how they're being broadly identified, assessed, and then prioritized again. That's a repeat, that one. How these risks are being monitored and managed, and then the extent to which these processes are integrated into the overall risk management process. So it's hard to sort of get a sense of how you do this without looking at some examples. So what I wanted to do just as we jump into this section is just remind everyone of the different types of risks that are at play here. So we've got the transition risks and then the physical risks. And it's just a useful reminder here from Barclays on the transition risk side, down at the bottom here. Barclays may face greater scrutiny of the type of business it conducts, adverse media coverage, reputational damage, and financial and operational risks as well, which may in turn impact customer demand. So it's these broader transitional risks that you are looking at managing within the financial institution, as well as just the sort of basic physical impacts. And so, for banks in particular, what we're looking at here is how do you assess how your customers that you're lending to are going to be impacted by climate-related physical and transition risks. How are they going to be impacted by carbon taxes, by regulations stopping them or changing the way that they operate their business? How are you going to harness the opportunities that are arising in terms of lending to facilitate the transition to a net zero or lower carbon economy? And so this one was a Lloyd's example where they are just at a very high level explaining what they're doing on the risk management side, and then they go into the detail of this, and they have 4 or 5 pages of their report is dedicated to explaining how they are doing this. And the main one here to pick up on Rich's comment earlier is continuing to embed climate risk into their activities and into their existing enterprise risk management framework. And they've done this particularly as considering climate risk as its own principal risk. And I've seen a number of examples there where banks are embedding climate risk into their existing risk management structures, but they're also recognizing it as a principal risk. And here they've introduced what they're describing as their group climate risk policy to give an overarching framework. And I've seen that a lot. And I think for investors looking at whether this is being taken seriously on the risk management side, they are looking for particular climate risk policies and details that have been then integrated into the broader risk management within the bank. This is a good example of just how to do this and make it clear what you're doing to investors. Here, we've got an example of 7 principles that the bank has put in place to guide its risk management of risk and opportunity management. And you can see some of the similar themes coming through. So, for example, Principle 2, the group will identify and assess potential climate risks and opportunities, including how these impact. Will embed appropriate scenario analysis capabilities. That's something we're going to cover in our next session. Principle 5, the group will set an appropriate risk appetite for climate risk. That's something that entities are increasingly doing, is setting a specific risk appetite for how much risk they're prepared to take on. This is a good example of how these different climate risks are then popping up in the different sort of categories of risk that the bank is managing. So here you can see on the left, you've got a distinction between credit risk and market risk for the banking sector. So credit risk focusing, and this is where all the detailed bullet points are on the particular policies and changes that are going to affect customers that the bank is lending to. So this is the examples I was covering before. Adverse coverage of the group's exposure to high emission sector, flood damage to particular properties, reduced production for commercial banking customers, and then the likely impact that may have on those customers' abilities to repay loans. So that's the specific credit risk. But then you've got separately the market risk. So where the bank is investing in equities or other investments, how are those investments going to be impacted by these same factors and changes in customer demand? Then you've got particular focus for underwriting, for conduct risk, and so there we pick up some of the greenwashing concerns. So one of the things obviously to be concerned about with all of these disclosures is avoiding suggesting that you're doing more than you are, because then you get into the greenwashing territory, which we're going to look at in a bit more detail in the 4th session of this set of workshops. This one was something that I wanted to pick up on just to show some of the examples of different tools that were being used to identify climate risk. And here you can see on you've got a climate risk integration plan that Barclays has set up with 3 objectives for how to integrate risk within the business. And the third one there is specific carbon modeling that they're doing. The second one is the work they're doing on scenario analysis. And then you've got on the right-hand side, you've got 2 tools being used as examples. So they've got a 2021 stock take exercise where they established a baseline assessment by risk type and across different entities. And then separately, they established a separate climate risk register, and they used that to then inform the risk appetite that the bank was willing to take on. And here they had the breakdown of all of the different key risk drivers for the different types of physical and transition risks. And that's something similar to what we were just looking at in the previous example. This is another good example of where climate change risk is being broken down into these different categories. So you can see in the middle here, you've got credit risk, market risk, treasury and capital risk, and operational risk. I thought this was a particularly good one for those in the banking sector to sort of see how this has been done. One of the things you can see there under credit risk, the first bullet point is that the bank is reviewing individual obligors' exposure using what they're calling the climate change lens. And I'm going to pick up on what that climate change lens is in a second, because it's a tool that the bank has put in place to allow the bank to look at all of its lending individually by customer to identify whether there are particular climate risks to that lending that it hasn't previously taken into account. You can see down the bottom of this, you've got ownership of the various different risk officers that are responsible for making sure that these different risks are addressed in these particular ways and integrated across the business. And then this is a good example of how these different risks are then described, identified, and measured. And so you can see that certainly from a banking sector perspective, the expectations around the level of detail of these risks is relatively advanced, and this is reflecting some of the sector-specific guidance that has come out from the TCFD around for financial institutions. But you can see that for the entities that are having to report on this, as you start to get examples of this kind of detailed reporting in the market, if you are not reporting in terms of these different areas of detail, you start to look as if you are not taking this as seriously as your competitors, and so that is going to be one of the major things that is driving increase in performance in all of this reporting. This was a good example. That this one probably should fit properly within the strategy disclosures, but it was just a bit of an example of how the bank is connecting the work that it's been doing on risk management to its strategy. And so here you can see they've identified, they've got sort of 7% exposure in terms of total loans and advances that they're making to climate risk, and then they're breaking down that 7% by sector and by actual figures in pounds in this case as to how exposed they are in these different sectors. So you can see, an understandably significant exposure there to oil and gas, and then to power, utilities, some in agriculture, some in the automotive sector. So relatively a little bit of coal as well that they're disclosing, some mining. It's a relatively expected disclosure there. This is the credit climate lens that I just discussed in the previous example. This is what Barclays have done. So they have set up what they're describing as a credit risk materiality matrix, known as a credit climate lens, to identify and assess how climate change may impact their credit risk exposures. And so they're doing this credit climate lens review completed for, in this case, wholesale clients operating in elevated risk sectors with a material exposure of more than £5 million. And it's completed by the banking or credit risk teams right across the group. And so the lens, as they describe it, consists of a set of 20 questions grouped into themes that are used to assess the impact of the physical and transition risks of the borrower. And so you've got a couple of examples of the questions. One of their questions around transition is, does the company have an adaptation plan in place? So they're using this as a way to get more detail from their borrowers as to how exposed they are, so that can then inform what the bank needs to do, whether the bank needs to take action, reduce lending to those borrowers, or work with them to increase their resilience, whatever strategic decision the bank wants to take about how it's going to manage this risk internally. So that is taking us almost to the end of these examples. This is just one which was focusing particularly on how the risk was being integrated across the business, and they're deliberately trying to show that they are integrating climate risk management with their broader risk management. This one was an example from Bank of England of what I was talking about before, which was how climate risk integrates how climate risk is developing over time. And they're sort of in that middle box where they are at the moment. I can see there's a couple of questions that have come in Spanish, which I'm sorry I can't assist with. Gabriella, could you help me just translate those two questions so that I can deal with them before we close, or we can I can ask for those to be translated and I can explain them next time.
Hi, Nicola, this is Mariana. So one of the questions made by Alba from the National Banking and Securities Commission says, is there any data on how much does it cost to integrate and disclose ESG by financial intermediaries? For instance, for a specific ESG areas department in institutions, is there any available data to know the cost for companies to disclose this type of information?
Not that I'm aware of. I'm gonna check if Rich does, but that exact question has been asked. It was asked in the UK when I was there, and also it's been asked in New Zealand now. From my experience working with banks, you know, you've got specific staff having to be brought on board with expertise to deal with these disclosures. So, you know, we're having a team of people that needs to be created to deal with preparing for this reporting. And the hard thing for banks is getting access to people with the right experience, because this is such an emerging field. Obviously, you want to draw on your internal experience as much as you can, but from the clients I've worked with, they've done that, but then they've found they also need to bring in expertise to allow them to do this properly. So you're looking at the cost of that internal resource, but also, you know, often getting this up and running, you're looking at working with external consultants, etc., to sort of just help you work through how this might be done within the bank. The real the real forward-looking cost, and I guess, you know, you have to look at this as an opportunity as well, as how are you going to integrate this within the bank? How much emphasis within the bank are you going to put on, for example, training up individual banking consultants across the bank to be working with customers to help them identify their risks and become more resilient, because that will ultimately be in the bank's interest. I mean, there's a potentially infinite cost there, but also that is part of the opportunity with customers. Rich, are you aware of any particular data? I wish I was, but
no, I'm not, and I'm really not sure that it's out there at the moment. And I suspect, Nicola, it's partly because, as you say, this is still an emerging area of work and responsibility for institutions. It's really only over the last couple of years that we've seen the type of reporting and those structures that Nicola was describing, governance and risk management structures, really get established. So no, it's the sort of thing, I think, Nicola, that perhaps, you know, the TCFD Secretariat, you think, you know, in due course, perhaps they ought to pick that up as an idea, maybe to, you know, to be able to demonstrate the cost benefits of introducing, of building this expertise for institutions and companies. But no, not aware of anything out there at the moment.
Thanks, Rich. And that final question, I think it's can we send the presentation by email, which of course we're very happy to provide the presentation. If I'm translating that correctly, Gabriela, you have to help me if I'm not.
Well, Nicola, this is Humberto. I have another question, maybe because Mariana has some problems. But the question is, should future priorities should be included under TCFD reporting like NatWest did? What are the implications with investors' expectations?
So sorry, Humberto. So if you are including this kind of reporting, what are investors' expectations as a result?
Yes, well, I'm going to repeat the question. Should future priorities should be included under TCFD reporting, like NatWest did? NatWest, I'm not familiar with that name. Is NatWest did? What are the implications with investors or expectations? I don't know. They are talking about if the TCFD should do what NatWest did, and I don't know what is NatWest.
Yeah, sure. There's no one correct way of doing this. I think that is something that reporting entities should take heart in. So all reporting entities have to do is make disclosures that allow users to understand how they are properly managing climate risk. And so I think reporting entities, they need to work through the process internally to work out what they can disclose, because the biggest risk here is that as you say, you disclose something really specific, like a particular priority or a particular commitment, and then you can't meet it. And so when you're doing your reporting the following year, you can't measure up against it, and that then looks worse for investors than if you've just taken a more conservative approach. So there's a balance between deciding how ambitious you want to be in terms of your reputation in the market and what you can actually achieve. And certainly I've seen some of these entities pull back on some of the targets they've been putting into their strategy disclosures to make them more achievable, while at the same time wanting to show that they are, taking this seriously, and some want to be leaders in how far they're going. So I think, yes, it's important to disclose as much as you can, but don't go too far before this has been really worked through in detail, because that otherwise that's going to get entities into problems. I hope that answers the question. If there's a specific question on a particular slide I've shown, I'm very happy to cover that at the beginning of the next session. Just send me through an email and I can do that.
I think that's so. Sorry, Richard.
No, I just wanted to add one point. I mean, Nicola's answered your question basically, Umberto, but yeah, that's all. Question about whether entities might go too far, particularly I would say where it might concern commercially sensitive information. You can see there understandable caution, and investors aren't necessarily looking for that, but they're looking to see are companies properly, are they seriously taking climate change in the first place? And that's really the broad test, and then going into the various detailed ways. But yeah, just my advice to any entity there was obviously be careful about sort of disclosing anything commercially sensitive, like what's the carbon price that you're operating internally at the moment, things like that.
Perhaps one final thing I could do is just show, I had one more that I was thinking of showing here. This is an example of how a bank is moving through time in the sophistication of its disclosures. And this is the example I was talking about before that can be a useful way of explaining, this is what we're doing on governance now, and this is what we expect to do on governance next year and the year after that. And that's a nice way of signaling where you are moving, even if you haven't got there yet. Sorry, Umberto, I'll stop.
No, Nicola, Richard, I think that was that was very useful for everyone. And no, thank you very much. I think that those are the questions that we have at the moment.
Well, that is great. Well, look, we're very happy again to take any questions offline and bring them into the next session. So please do send those through. And otherwise, thanks very much for joining, and we'll see you at the third session.
Yes, thank you, Nicola. Thank you, Richard. Thank you very much. And I think that it has been very, very helpful and give us a lot of context about all the TCFD in the part of the governance and the complications that we may have. So thank you very much. And thank you, everyone, for your participation. We will see you in the next webinar. Thank you. Have a nice day.
Bye, everybody.
Thank you. Bye. Thank you, Nicola. Thank you, Richard. Have a good night and day.
Bye.